Right, today on the podcast, we are going to talk about financial literacy. We're going to talk about how to invest and hopefully get a plan for online coaches, online business owners to be able to turn what is sometimes a bit of a very up and down, financially erratic job into something that's, a lot more stable and has a real future to it. So obviously I'm not going to talk to you about that because I'm definitely not fucking clued up. Well, I am sort of, but we've got an actual expert in whose fucking job and who's been accredited in some way, shape or form to talk to you about it. Ryan, who's my financial advisor. So I think the best place to start is, how does everything work with financial advice? Because I got told when I was like, if I heard like financial advisor when I was a kid, I thought like that's only for rich people.
Yeah. So, and this is where I try to be a lot more relatable to the younger generation. And you'll see on my Instagram, I'm a wealth coach. Look, I'm a qualified financial advisor, and go back 3 or 4 years, I just did the standard service that all financial advisors do. And even my image of a financial advisor is some old, guy, bit boring,
brown suit. Always in my head, it's always
comes,
brown.
has a coffee once a year with your mum and dad, talks about pensions, and there's still a lot of those financial advisors out there. And it once was purely for the people that are already wealthy, and they just wanted you to manage their money. And, for, I would say, 8 or 9 years of my career in wealth management, that's what I was doing. I was just managing wealthy individuals' money, pensions, etc. But my approach on it now is I'm trying to help the younger generation, and I'm part of their journey with them, whether that's right from the start or whether it's their first 50K, their first 100K, whatever. I'm open to work with clients that are doing well for themselves by an income amount, so they've got capability to invest, and then I'll guide them and nurture them and help them make, good financial decisions. So, like you say, in your line of work, you've got a lot of income-rich coaches that are doing extremely well for themselves. But 5 and 10 and 15 years down the line, we want them to be asset wealthy, so that then their assets can take care of them and pay a passive income should they need it. Maybe some people want to work for 30, 40 years, like a full career, but we can never say never. Income can always be temporary, and if income stops due to ill health or a bad time in business or just an industry change, at least you've got something to show for the work that you've done for the last 5 or 10 years. So hopefully that explains a little.
No, it was, yeah. That was one of the issues, obviously, that I had when I was growing up. Is my dad, did a lot of like labor and like manual work, and at time, I never know because he never really said anything, but I know when I was working with him when I was like 16, 17, like he's making all right money. Like it was better than all right money. It was good money for what a lot of people earn, like where I'm from. But I think something happened around the financial crash with like ISAs and stuff like that. And I think, I might be wrong, but the way I understand it is he took it out, because it started crashing, and then, that all that work that he'd done over the years and saving up and putting all that away for his retirement was kind of fucking gone, like in a heartbeat. So that was my first ever like experience of like financial advice, because I always thought, because my mum was in teaching, like it's always been pension, and I got told to go into teaching because it had a good pension. It actually fucking didn't. That was lies. They changed it like as I was qualified.
So that had been before that I've had final salary pensions, same as your NHS, called defined benefit schemes.
Yeah, from what I understand, the teachers used to fucking love it.
Income, and it's an average of your earnings during your career. Don't forget, pensions are old-fashioned, and pensions were basically, set up back in the 50s, 60s. People would retire and only have a short retirement. Life expectancy wasn't as long, so the promise of income was only to cover them for 5 or 10 years, let's say. Now, obviously, people are living longer. Life expectancy is mid-80s.
Is that why they're tightening it up now?
So
and they're not
they tightened the pension industry up and reformed it as to called defined contribution schemes, even like even NHS, civil service, police. A lot of the older people that have worked in those professions for years will still have the DB part, but anybody newly joining are just going into a DC scheme, which is a contribution that gets invested.
Right.
Okay, that is with then linked to the portfolio, linked to the markets or whatever. Going back to what you mentioned about 2007, 2008 financial crisis, and obviously your dad's money going down, and him pulling out. So I started working at Lloyd's Bank in 2007, just as everything crashed. And at that point, I think I'd have been about 22, 23 maybe. And that crash, just changed the financial industry. But the whole point there is, if your dad would have had a financial advisor, and the financial advisor would have been on the ball in urging him to stay invested.
Don't think no one can tell my dad anything, to be fair. To be honest, I think once he's that kind of bloke.
Yeah, so it's like, at that point, yes, your value's gone down, but the best thing to have done there would have been to hold and wait for the recovery, which took around about nearly almost 3 years for the full recovery, which was quite a long recovery. It was a U-shaped recovery. Yeah. Usually, like the pandemic, for example, were a V-shaped recovery on the crash. But the best thing to have done would have been to pay more in during that period and let it just ride it out. I think we then got into maybe a 10, 11-year bull run in the markets. So after that point, after the crash, we then saw a real upwards trend in the markets, stock markets, etc. A couple of dodgy years, 2011 Euro crisis, 2018 wasn't great, but 2020 was actually the next big crash because of the pandemic. So going back to me working in the bank, at that point I'd started investing, but I was mainly just saving and properties at that point. Didn't know much about stocks or shares, and again I would just starting the career in banking at that point. But I'd been waiting for that big crash to happen again. For the majority of my career, I was still investing the whole way through, but I'd remembered that last financial crisis, that last crash, what happens to the markets, and then how much of a recovery we had. So even though I was investing the whole way through, I didn't want to be on the sidelines because I didn't want to miss out on the growth of the markets. When the pandemic hit and we had this big crash, I literally put everything in. Yeah. Okay, and from 2020 March was a crash to now 2024. In this last 4 years, I've probably made as much profit. Let's be honest, way more profit than I did in the decade leading up to that, because I'd got more money invested. Yeah, so it's just about staying the course and having consistency and just putting more money in, buying as many units and as many stocks and shares in the market as possible, and when the markets come down, double up. Yeah. So basically, put everything that you can at that point, and then wait for the recovery, and that's the way you make profits long term.
Do you think that takes a lot of trust, like in someone? Because, like, say for example, like I was just saying before, like it's hard to tell my dad anything at the best of times. I guess if you don't have a great relationship with your financial advisor, if it's just a bloke that turns up once a year and has a coffee with you, and he's like, mate, leave it. You're seeing your money go down. Bearing in mind, you're not from money. So, like, you've got this number that you've worked all your fucking life for, and you're seeing it going bing, 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 bing. You're thinking, fuck me, I'd rather... Because safety is the first thing that goes through someone's mind, innit? It's like, I'd rather have this than nothing. So, like, how do you get over it? Because then somebody like yourself would be like, yo, the best thing for you to do right now is leave it and actually... put more in and still maybe potentially watch it come down a little bit, like, because it's you don't really know where the bottom is until you hit the bottom, right? How do you get that level of trust to someone to be able to sit across the table from them and be like, go big on this?
So again, that's all down to the relationship that you have with the client. And again, I just always try and give clients very open, honest, transparent advice. And a lot of the times I'm advising clients to do, look, this is what I'm doing. This is what I've done. And I can even show clients, look, this is what I'm doing. These are the transactions. These are the places where I'm investing my money right now. Follow my footsteps. It's worked for me. But also, the longer you've been investing with someone, you've seen those divots. You've seen those dips. I think people are becoming a lot more financially literate these days anyway, just because there is a lot of information out there that possibly wasn't available to the older generation. My dad would be exactly the same as you, by the way. I actually managed my mum and dad's money, right? And for years, he had his old pension schemes, and he was in what we call fixed term bonds, and cash equivalents. And I'm like, Dad, you need more equity exposure. You need more stock market exposure. He actually only went more heavy on the stocks at 2020 crash.
Yeah.
I think his average return on his pension for like 30 years has been about 2.5%, 3%, same as what cash is doing. And since I actually encouraged him to invest more heavily into stocks during the pandemic, it's rocketed. You know, he's made way more money in his pension pot. And again, when I'm helping people to manage their money, in the back of my mind, I'm always like, if someone was advising my parents, because again, I used to deal with a lot of older generation clients. If someone was advising my parents, what would I want for my parents?
Yeah.
And then for the younger guys that I deal with, it's like I treat their money as if it's my own way. I'm not going to put your money into something that I wouldn't be buying myself. Do you know what I mean? So that's the trust element there is, look, this is what I'm doing, you know, and I'll publicly put on my social media, I'm buying this particular property development, or I don't like to boast too much about what wins I've made on my stocks and shares, but any client of mine ever wants to see my stocks and share portfolio and what I hold, what ETFs I've got, what managed funds I've got, I'll be completely transparent, and I'll log on and we'll do a screen share, and I'll say, these are the ones that I've invested in, these are the profits and percentages that I've made. You need to be doing the same kind of thing if you want your money working harder for you.
Do you think there's a difference between the habits of the older generation and the younger generation? Like maybe the older ones are a little bit more like, oh, I'd rather just keep it where it is, and the younger ones are a bit like, yeah, bro, I'll just like sell everything I've got and like go heavy into crypto.
So yeah, I mean, I think younger generation definitely are way more open-minded to investing and open-minded to risk. Okay, going back years and years, yeah, people were a little bit more reserved, a little bit more conservative. But also, the older you are, that's naturally how you become.
Sure.
So you just think about, even just in life, the younger you are as a kid, you're taking risks, you're climbing trees and all this. You know, you get the boy racers when you're in your teenage years, driving fast cars.
Wasn't a fast car that I crashed into. It was a Volkswagen Fox.
And then the older you get, you become more steady with the way that you drive and, you know, the risks that you take. It's exactly the same with your investment portfolios. When you've got time on your side, time is an investor's best friend. Any market volatility, markets going down, you've got loads of time for it to recover, and you should just nurture that and keep buying in and see it as an opportunity. And then over time, the older you get, you want to de-risk your portfolio more and maybe come out of less risky assets, less volatile assets. And that's where you've got more fixed income. Again, property is a lot more of a much safer asset class, and obviously also kicks out rental yields, etc. But I think over time, the younger generation are more open-minded to risk and understand it better because of the information that's available compared to previous generations, parents, grandparents, etc. They just didn't have the knowledge, and they didn't maybe have the trust in the markets to kind of take those opportunities. Yeah.
So I think there's loads of scenarios that people run through in their head when they think about investing, but there's a couple that I think are quite interesting to look at. And it'd probably be good for you to explain, because I think a lot of people maybe don't understand how it works or why it works or even how to do it. And I think even sometimes, like when I've spoken to people with my, albeit limited knowledge about it, I don't think they realise how achievable some of the targets are. So I think one of the first ones, and probably the most common one for a lot of people, is, let's say, for example, I wanted 50 grand, like 50 grand a year is like a good wage, right? Nothing like, you're not going to be driving around in Lambos and stuff like that, but you'll be solid, like nice house, holidays, decent meals. If I wanted to earn 50 grand a year for the rest of my life, passive, how would I go about doing that?
So let's work on 60k, all right? Just so I've already got the numbers in my mind. So 5k a month, times that by 12, so you've got 60k per annum. You've got to think, when you're looking for a passive income, you're usually looking for that at your retirement age. Yeah. So I always just go on the numbers of, let's say you retire at 60 and you live till 80. So if you need 60k, you need to times it by 20. Okay. So 60 times 20, okay, is 1.2 million. Okay. But why the 1.2 million is a relevant figure is if you just think about mathematical calculations, if you've got 1.2 million and it's making a 5% yield, which 5% is nothing, right? You can get 4.5%, 5% in cash at the minute. And the reason why I say 5% yield is when you've got that amount of money, you want to protect it. It's wealth preservation. Okay. So when
I was going to ask why 20.
Yeah. So when you're in your younger years, chase the 10s, 12s, 15s, 20% returns. Use the volatility, buy in monthly. You're in a growth phase. But when you're older, you're a bit more conservative. You're in a yield phase. Okay. So you then want passive income, and the 1.2 million at a 5% yield will kick out 60k income. You'll never spend a 1.2 million. Okay. So you've also got to consider inflation. Let's say everything's 50% more expensive. So you might draw out 7.5% a year, which is called income drawdown, from your 1.2 million. So 2.5% of that is diminishing every year. Okay. But it still outlives you. It'll last you forever. It'll last you a lifetime. So then you've had your 60k or 90k out of it because you're considering inflation, and the money's diminishing. But when you do eventually pass away, there's still 500 grand in there for the kids that you pass on as a legacy. And that's just, don't forget, that's just let's say that's your retirement fund, that's your pension pot. You might also have properties.
So that's
you've got to think, what wealth's going to generate income? The house that you live in is not going to generate income. So that's part of your wealth, but that's your legacy wealth, but it's not generating an income, is it? So you've got to think, I need assets that are going to generate an income to me later in life. So it's looking at your financial goals and then reverse engineering those goals, working out what the figure is to generate the income, and then also putting a strategy together to reach that target in said amount of years.
Right, so that probably comes on to the next question. So we've just agreed, like 1.2 million will realistically give you a 60k income for the rest of your life, more or less. And you could probably fucking pay off your house and stuff like that with it as well, right?
Yeah.
Without really fucking with the pot too much, unless you've got a massive house. Yeah. Right, so next step is then, how the fuck do I get to 1.2 million? And I know, so obliging, like, becoming a millionaire. Yeah. So, like, I don't want to talk about myself, but like some people could just do 1.2 mil cash, couldn't they? They could just make 1.2 mil, put like 20 grand aside every month. You could get there fairly fucking simply.
Yeah, exactly.
That's 5 years, right? Easily. But how do you do it? Say you're earning between 10 and 20k a month, because I think that's probably, I mean, I don't want to say it's like really achievable, like not everyone can fucking make that money, but I think a lot of online business owners go in with that kind of peg mark in their head, like, this is why I'm doing it. Because I think if you're doing it for 3 to 5k, you might as well get a fucking job. But you get better benefits, wouldn't you, really? So, like, 10 to 20k, you're in that bracket. What's the fastest way for me to take that kind of money? I'm putting you on the spot here, sorry.
I know, yeah. And I have software for this, right?
But it's more like theory rather than like actual numbers.
Right. So there's multiple ways, there's multiple strategies. And a lot of the time, you are best to be diversified and go down 2 or 3 different routes. So I'll give you a couple of examples.
Right. The easiest way would be, right, I'm an online coach. Yeah. I'm doing, on average, about 15 to 16 grand a month. Sometimes it's less. Sometimes I hit 20s, right?
Yep.
I'm saying to you, Ryan, I want to get £1 million in the bank as fast as I can. But I can't earn any more money. There's a reason why maybe I can't hire staff, or I don't, I've got kids, I don't have any more time. So I'm capped at the income. So business, it doesn't work. You can't do that.
I've run the calculations before. Okay, I'm going to talk about an ISA. I'm going to give 2 or 3 different examples here. An ISA, you've got a £20,000 allowance every single year, but you can only put money into your ISA from personal savings, personal money that you've already paid tax on. So 20k a year allowance, that's £1,666 a month. If you whacked in 20 grand a year into an ISA, okay, you went into an investment ISA, stocks and shares investment ISA, you'd need to average around about an 8% return. Okay, stock markets, S&P 500 averages about 9-10% a year anyway, so it'd be quite easy just to track the stock market, S&P 500. It'd take you 20 years, but you'd clear a mill at an 8% return, just whacking 20 grand a year away into an ISA. Okay. So that's option 1.
And to put that 20 grand away, because I've done the calculations on this because I used to be in that position and that's what I did at that point. If you draw out 100k a year, you generally can put away that one because you get 6,666 after the dividend.
Yeah.
So that 1,666 goes away, and then you get 5 to live on.
So it might not be the most tax efficient way of pulling the money out to then put it into an ISA. Okay, and this is what my next theory on this is. The other way, especially if you're a limited company director based in the UK, rather than pulling the money out of your company, okay, paying tax on it to withdraw it, and then putting it into an ISA, okay, you'd be better off actually putting the 20k a year into a pension. Okay,
Right.
and again, pensions are old fashioned and your money's locked away. But look, everybody's wealth eventually becomes a retirement plan. So, therefore, the 20k that you're putting into the pension, you're saving corporations tax. So not only are you not paying dividends income tax on the draw out, but then you're saving corporations tax. It's an expense to the company. So you'd be 19% better off straight away on day one. Okay,
or 25.
Yeah, or 25, depending on what tax bracket you're at.
Thanks, Rishi.
and then the 20k going in, okay, again, an 8% return, which is fairly easy to make annually on average if you look at things long term. But that'd be £1,666 a month going into your pension. Okay, 20 grand a year going into your pension. 20 years later, you've cleared a mil there on an 8% return. So that's.
Can you draw it in 20 years? Let's say you're 25.
Well, it's at the minute you'd need to be 55 to draw income from a pension. Okay. So these are the downsides of a pension. Your money's locked away. There is no access.
55's all right though. Okay. It's not like you've got to wait till state retirement.
It works on your date of birth. So even for me, when I retire, it'll be 57. So whatever your state pension age is, you can draw your personal pension 10 years earlier.
Perfect.
So think mid 50s, 55, 56, 57. So the downside of a pension is locked away. The benefit of an ISA is it is liquid, it is accessible. You can take the money out. Obviously, there's loads of different ISAs. You can do Help to Buy ISA, you can do Lifetime ISA, but they are accessible. Okay,
let's say I didn't want to wait till 55. Let's say I'm a bit younger, a lot younger. Yep. Let's say I'm 25 because it happens a lot in our company. I'm 25. I'm earning that kind of money. I don't want to be a PT when I'm 40.
Yep.
I'll talk about property next, so like minus property.
Okay.
What's my route?
So you could do exactly the same, but you'd need to put a bigger input.
Okay.
Yeah. So forget about the pension. ISA allowance has got 20k. Put 40 or 50 or 60k away a year, but then you just have an investment platform, a general investment account. So you'd log onto your platform, you'd see your ISA, you'd maybe see your pension, you'd maybe see a general investment account. And you can still do the investment, but the only difference is if you've not got the ISA wrapper or the pension wrapper around the underlying asset, around the investment that you're owning, there's CGT to pay, there's capital gains tax to pay. So when you do make the profits and you do come to draw on it, you're losing money in CGT. Again, your ISA, there's no income tax to pay.
Yeah. Is capital gains less than income tax though? In general.
So depends on the
asset.
Say
that million amount.
Yeah. So on stocks, it's 10% as a basic rate taxpayer, and it's 18% on a higher.
So it's a lot. So it's a lot less
cheaper,
anyway.
Yeah, CGT is a lot cheaper. Yeah, but don't forget your assets that you own also kick out dividends income. And again, if it's in an ISA, there's no income tax to pay on those dividends. If you own it in a general investment account, you know what? We live in a country where we just get taxed heavily.
Yeah.
And the better you're doing, the more tax you're going to pay. Okay. So you're in a fortunate enough position to be investing all this money. It's making a profit. The government's going to take a cut. There's no way around it unless you're going to be savvy and have an ISA, a pension, or there is other structures you can put into place, which we'll talk about with property in a minute or two, and I'll give people a couple of suggestions and tips on that as well. But to get there sooner just means a greater input. Yeah. So if you want to get there in half the time, double your premiums, so to speak. Yeah. So it's all about capabilities. Obviously, the more you're earning, the more you can invest, the sooner you can get to this figure.
And that's about sacrifice now as well, isn't it?
Sacrifice now, and again, people will come in to speak to me for a meeting, and they'll fill out the inquiry forms. And if people aren't clearing, let's say, the 10k mark as a coach, the first thing I say to them is invest in yourself.
Grow your business.
Go to a mentor. Go to someone that's going to help you scale your business beyond that point. then come back to me, because investing in yourself and getting yourself above a 10k income is going to give you way more capabilities to then actually invest with intent. I'm not saying, look,
I agree. I think the 10k mark is like,
at the end of the day, if you're, I know this is obviously based towards helping coaches and stuff, but if you're on a salary, and you're doing a normal job, I'm not saying don't ever invest, because there's no point. You should still have a pension. You should still put your ISAs. You still,
usually the job takes care of that though.
You
as
should
well,
still be
doesn't
doing
it?
something. Doing something's better than nothing. But if you're a coach, you've got a huge opportunity out there, to earn ridiculous amounts of money, more money than doctors, consultants, more money than the Prime Minister makes. Yeah.
Well, on paper at least.
Well, yeah. So there's so much opportunity for them to make huge amounts of money. Get the help that you need. Maximize your opportunity. Then let's look at investing, and let's look at maximizing your future.
Because that's the way that I say it to people. It's like, you look at what you could potentially earn now. A lot of things come into like between that 10 and 20k mark in business. A lot of choices come in.
Yep.
It's like, do you want to handle a business of that size? Because once, I reckon, we usually estimate like 20k as being like, you can go further. I've got no experience doing it. So when I got to 20k, I started hiring people into my business. I'm sure there are ways to grow your business above 20k a month without hiring people. But that generally gets to a point where your expenses start to tick up and you need to take on full-time members of staff, and then you've got ramifications of like pay as you earn and all of that stuff. So like 15 to 20k is where a lot of 15 to 30, if you can run multiple programs and you've got the brain for it, you can probably sit in that mark. So I usually tell people to aim for that, and then they can decide whether they want to turn into like an actual company and have other people, or they just want to keep it like, a lot of people just like to be self-employed, and I think there's a difference. So like self-employment for me with like online PT ends between being like 15 to 20-ish before they really are up against the wall and they're like, fuck me, I'm working all day, yeah. So at that point, that's when I always that's where I look at people getting to before they start investing, because then I think you've got two routes. You either invest in the business, in staff and procedure, and you can make bigger returns that way. But not a lot of people want to do that, and to be honest, I think it's riskier than putting it away somewhere else. So I think people have that choice. So the other option I was going to ask you about is when they get to this mark, right? So say you're at 15 and you go, I don't want to grow my business. Take 15. I don't want to grow my business anymore. I don't want to hire staff. I want it to be me. I like that it's me. I don't mind doing all of the jobs. I just want this to be a very good income for myself. I don't want to build a team, etc. A lot of people then will look at like doing something else or getting into something else, and this might not be the same for like a lot of the listeners, but like where I'm from, the people that did well for themselves got into property. They made some money doing something. Sometimes it's not always the right stuff.
And then they put it in.
But then it's in property.
I call this a safe point, by the way. I'll come to this in a minute.
Okay, so yeah, it's like start owning properties. So how would somebody earning that kind of money transition then into maybe, over a period of years, not being a coach anymore and actually being, a property owner?
I'm going to, a couple of bits of useful information that got me thinking about this. So I always think back to, a big football fan. Premier League in the 90s for me and 2000s was just amazing. But then you think about the footballers from that era, okay, that didn't have maybe the right people around them to advise them. I guess they didn't have financial advisors. Teams should actually have people on point these days, right? But you got all the 1990s Premier League footballers that had like maybe 15, 17, 18-year careers, were earning millions, but not what they earn today. A load of them retire at 35 bankrupt because they got all the expenses, the liabilities, the cars, the big mortgages, the big mansions, and then the career finished and their income just falls off the end of a cliff, and they can't afford the lifestyles and they're all bankrupt. So I'm not saying that's the same for coaches, but there could be a lifespan on business. There might be a lifespan on you actually wanting to be in business and the stresses that come with it.
That's half of it.
The mental stresses with it. So it's about having what I call safe points. Brilliant. I've got my business up and running. I've got it above 10k. I've got it to 15k. I've got it to 20k. That's great. Are you going to continue scaling it? Are you going to continue investing back into your business? Or do you start looking at all this profit and income that I'm making? Okay, so you can only pay yourself a certain amount of income without getting screwed by tax. So then there's just profit that's sitting in the company. Okay, and that profit, think about playing computer games. You got to level 1, level 2, level 3, level 4, and you'd get a safe. You'd save where you are. You get a save point, and then you might lose on the next level. Anyway, but you might lose on the next level. But you can start.
Be a millionaire.
Yeah, you can start from there, right? Yeah. So your business is going well. You've had 3 years in business, 5 years in business. You're doing extremely well. Okay, there's profit in that company. Most people are scared to do anything with that profit because they just think, well, if I'm drawing it out, that's going to trigger a tax charge. If I take it out as a salary, if I take it out and I go above my 50k, I'm at a higher rate tax bracket. If I take it out as dividends, again, too much dividends, I'm paying more tax on it. So just leave it in a bank account. Yeah, and most of these business bank accounts haven't even been paying an interest. You can get interest savings on business accounts now, Monzo, Tide, etc. But for years, they've just had people sitting with high values in the bank. And again, your option really are pay it into your pension, lock it away for long term, save your corporation's tax, or set yourself up a property company, which again, we've given you the advice on this in the past, Steve. You set yourself up a property company, okay, and you think there are old Premier League footballers like Gary Neville, like Robbie Fowler, like Michael Owen that must have been more sensible than the other ones, Faustino Esprilla and all these guys.
Not even that, like we used to
that have done that, right? Yeah. But as a coach, you can be a director on multiple companies for your own benefit. So you're a director of business A, your coaching company. You make yourself a director of company B, a property company. You can intercompany loan the money from company A to company B because you're the director of both companies without a tax trigger charge. Okay, so it's still profit of that company. You're still paying corporations tax on your company A, but you can utilize the money. You can loan it to the new company. Okay, they borrow it, and then you can use that money then as a deposit to buy properties. And again, I'll give you some simple maths on kind of the investment points where I help clients to buy. It's like 200k upwards. Yeah, so if we just look at 200k upwards. Some properties, city centre apartments like Manchester and so on, you can pay 400. Some in London, you can pay $1 million.
I'm feeling it now.
Do you know what I mean? So, but let's just work on 200k because for 200k property, you need a 25% deposit. Okay, so a buy-to-let mortgage will be 75% loan to value. So if you've got within your fitness business profits building up, and you always want a safety net there afloat, but there's £50,000 surplus cash there that you could do something with. You buy a property at, let's say, 200k. That property is going to generate £12,000 a year rental income, about £1,000 a month rental.
Is that profit or?
Okay, so this is the thing here. It's going to generate £12,000 a year rental income, but you've purchased a 200k asset with a 50k deposit. You're using the bank's money to buy it. Okay, now your £12,000 a year rental income that it's generating is just going to pay the mortgage. Okay. You're going to see no monthly income in your back pocket from that company. More income means more tax. More tax is stopping you from becoming wealthy. Yeah. So we want that business really not to be profitable. Yeah, the business isn't profitable. You own the companies in the business, and the only tax you've got to pay is corporations tax on the profit of that company. You're drawing no income from it, okay, but it's not profitable. What happens? Over 10, 15, 20 years, the value of the property increases, okay, so you get growth on the 200k asset. So
because the apartment goes from 200 to 250.
Let's say it goes up 10%, you've made 20 on your 50, okay, and the interest on the mortgage, someone else is paying that. Yeah, so it's good debt. Yeah, you've got bad debt, good debt.
So you would recommend in this situation using all of the rental income that you would get to actually pay down the mortgage to do a full repayment rather than a...
Yeah, because as well on a business, you can claim back all the interest as an expense. If you're buying property in personal name, you're doing personal buy-to-let, you can't claim back the interest.
You used to be able to.
You used to be able to. I think now you can. I'm not an accountant, but I think now it's about 20% of the interest.
It's definitely not as profitable to be a personal landlord now.
But we don't care if that company's not profitable for 20 years. The only time that company's going to be profitable is when the debt's fully cleared. So then all the rental income is profit. Yeah. Or you sell the property, okay, and whatever you've paid for it, whatever it's worth now, is a profit. Yeah. If you bought it in personal name, it's a CGT tax. But if you sell it within the company, it's a corporations tax. Corporations tax is less than CGT if you're a higher rate taxpayer. It can be 28% on CGT on properties, 18 or 28. So, but if you rinse and repeat that, my take on this is hold it for 20 odd years, hold it for 20 years, hold it for 25 years. Essentially, you want the debt paid off 25 years down the line. Growth rates in places like Manchester city centre, Birmingham city centre is about 4.5%, 5% a year. The property should double in value. There's no guarantees on that, but property up and down
from
the UK,
history.
Yeah, from history going back, generally grows around 2.5% a year. But certain locations up and down the UK are growing at a much faster appreciation. If your property doubles in value, okay, it's worth 400. You put 50 in, okay. The rental income 20 odd years down the line isn't 12 grand a year. It's 30 grand a year. So from that,
so your investment sort of grows with inflation better than maybe.
So you've planted a seed, right? That's like a seed that you've planted. It's like planting a tree, right? It takes years for it to grow and blossom. It's a 50k seed, okay. In years to come, that 50k seed could potentially be worth 300, 350, 400, and it's going to be giving you a nice rental income. And at that point, you're going to need the income because at that point, you're going to be looking to retire. I would imagine, you're in your 40s, in your 50s or whatever. So you've also got to think when you're investing, what's my objective? Am I investing for income or am I investing for growth? And even though we've bought and invested into an asset that's generating income, you're not seeing that income because more income is going to mean more tax to you.
Yeah, and you wouldn't anyway, would you?
To service the debt. Yeah.
Because the other way of doing it is obviously what some people do that maybe don't run their own businesses is they like get a little bit of money and they'll buy like a rundown house and flip it.
Yeah, renovations and flipping. And
I'm assuming, I think I probably know your take on this, but correct me if I'm wrong. You would assume that doing that is because you've got a capped income in your salary and you doing more work in your job isn't going to get you a bigger salary. Yeah. So you might as well, the extra work that you want to put in, you might as well put into doing a reno. But for a coach, you wouldn't do that because actually that extra work, you might as well do in your own business and make the extra money. I was just wanted to be clear on that.
Steve, so again, my first two investments were properties, run down, financial crisis, everyone were getting repossessed. I could get cheap lending from the banks. I worked at the bank. There's more than one way to skin a cat, poor cat. But anyway, I'm not saying that doesn't work. Renovations, like if you want to make money on property, renovations is a good thing to do.
Yeah. I'm only talking about it because they'll see it online, right? They'll see these people that like flip houses.
Oh yeah, listen, it comes so that we don't use this strategy, right? If you're going to do a renovation, if you're extremely good at DIY, okay, and you're not having to pay people to do all the labour and you're not having to pay people to do all the renovation for you. You're going to get involved and you've got time to get involved. You can definitely make money on renovations. You're buying something undervalued. You buy it, you renovate it, it's worth more. You can sell it, you can flip it. But when you do that, if you buy it in personal name, there's a CGT. Or if you buy it via a limited company, you're going to pay corporations tax. So then you've got a deduction straight away again of tax. You've made profit, but you've lost some wealth. And you do it again and do it again and you do it again. If you've got time to run a fitness business and spend your weekends decorating,
fair play. Yeah.
Good, great. And again, I did this when I were at Lloyds Bank. Completely different scenario to where I'm at now. I was on a salary, might have been making 45, 50 grand a year. I was saving money and I was getting enough money to buy properties. And I did two with my brother. My brother's extremely good at DIY. I just labour for him. We tried to sell. We'd not made enough profit. I still own both properties. And I've rented them out for years on end. Yeah, we didn't even sell them. They're two small little semi-detached houses. One's in the council estate. And also the issues that you get with older houses, right? And the issues that you get with tenants that can...
In those kind of houses.
Yeah, it comes with
that's
hassle.
Like Charlotte said to me, like my missus, because she watches TV during the day, which is bullshit. But one of them ones where like the landlords are like having to go in and repo houses that people haven't paid rent, and like they've trashed the gaff. There's fucking like it literally looks like people. And she was like, "You're not worried about that?" And I was like, "I think." And I've not had this, but I'm assuming that because of the apartments that we've invested in, it's less likely to happen with the bigger the investment.
So I always speak from my own past experience. I have those types of properties. And then when I moved to Abu Dhabi at the age of 26 and I started earning more money and I weren't paying tax, I got involved in your network. I got involved with property consultants, and they kind of changed my opinion and my mindset of buying city centres, okay, and buy properties that only like professional people can afford to live in. Yeah, because then when you buy an apartment, it comes with a 10-year build warranty anyway. It's brand new. You're not going to have any issues with the boiler leaking. You're not going to have any issues with the slates blowing off the house. There's less. There's less at Grenfell.
My friend bought one of them.
Yeah,
not Grenfell, but one with the same kind of cladding. You can't sell it now.
So there has been issues like that in the past. Obviously, regulations now have tightened up a lot, obviously, over the years. But generally speaking, you're buying stuff that's brand spanking new that doesn't have any maintenance. And again, just speak from my own past experience, I bought an apartment at the Assembly in Manchester City Centre back in 2015. I think I paid $186,000 for it back then. I've just had it valued recently at $250. Years ago, I was getting $650 a month rental income. I'm now getting $1,000.
What did you actually put into that cash to start it?
About $50,000 in years back.
Fuck, it's a good return, isn't it?
Yeah, do you know what I mean? The mortgage has come down to about 110 now. I'm just refinancing actually, so I'm on a stupidly high rate. All rates have gone up, but I'm just getting a remortgage. But my point here is, in that time frame, I've missed 1 month's rent because during the pandemic somebody moved out and it took us a month to get someone else moved in. Not me, but the estate agency team. Someone burnt the carpet with the hair straighteners once. Okay, do you want to change the carpet? No, just put a rug over it. I'm not going to change a carpet for a small burn. And I had to reseal the sink. It's cost me nothing in terms of servicing. My other apartments, so my other properties that I've owned, one of them $4,500 on a boiler that I had to change because again, it's an old house. All the pipes were leaking, and every year the tenants say, "I've got a leak. I've got a leak. I've got a leak." My dad's in the building. He was going down and sorting things out. I just felt bad that he were having to go and do all this. So in the end, right, we'll just change the boiler that was $4,500. Her ex-boyfriend punched holes in doors. Doors being kicked off.
Not me, was it?
But do you know what I mean? You get like issues with those types of houses. But it was a starting point, and again, they've still been good investments, but they come with more hassle. And I actually was involved in the renovation. At that point, I spent my evenings and my weekends working to make the money. Whereas the approach that we're doing with off-plan apartments is it's passive. I call it armchair investing, like an armchair football fan.
It's as passive as it gets.
Yeah,
at least,
me basically. I don't go to the games, right?
Yeah.
So armchair investing. I'm your advisor. Apart from signing paperwork and doing a mortgage application, speaking to a solicitor, it's as easy as it gets. We'll advise you on the financials, where you're going to get the best ROI, which apartment, and also what's going to be as little hassle as possible for you moving forwards. It's always like no pain, no gain. The hard point is just getting started, getting the company set up, finding the correct apartment, getting all the applications and paperwork done for the mortgage. And then once you actually own it and the estate agent's managing the tenant, you might get an email from your estate agent every couple of years saying your tenant's moving out, but we've found another one. Oh yeah, the rent's going up, by the way. Do you agree to it? Yeah, of course I do. Great.
Yeah.
So
good. So on that safety point again with property, like we said about stocks and shares, like talking about that 50 or 60 grand a year type.
Yep.
Let's say I was an online coach and as quickly as possible I wanted to start buying property so I could replace a 5 to 6k a month income.
Yep.
What kind of strategy are you looking at there? Say I want to go from being an online coach to being a landlord. I just want to manage my properties. I want to sit with my feet up, get 5 or 6k. How many properties am I going to need?
So, look, in our strategy, so we're always looking at more longer term financial planning. But that being said, the reason why we say that as well, the less amount you put in of your own money, the bigger the ROI. Yeah, because we're using leverage, the power leverage. So that's why we always try and only put 25% in. And over a 20, 25 year period, it works that it gets paid off and so on and so on. But let's say I've got clients that have done this strategy where they're in their 50s and they want to retire in 10 years, they want to retire at 60, or clients that are in the 45 and they want to retire in 15 years. You put a 50% deposit down. Yeah, and you have the mortgage cleared in a shorter time frame. So it's just playing around with the numbers. So again, you know, if you own 4 properties and they're all kicking out £1,000 a year, a month, you've got £4,000 there, but you'd need to physically own them outright.
Yes.
So are you going to put 200 grand in to get 12 grand a year? It's not the best investment strategy, is it? Do you know what I mean? Whereas if you put 50k in and then you wait and you're patient, that 50k that you've put in can quite easily become 100k equity within the property as the price values go up.
So you're looking at like
down.
20 years being like good.
There's no quick fix on it, unfortunately.
Unless you're going to actually go and do the work.
Unless you've got loads of money and you're just going, I'm going to buy that property there, I'm going to buy that property there, I'm going to buy that property there. You know, that's going to give me rental income, that's going to give me rental income, that's going to give me rental income. So it's very rarely I help clients invest for income today. The only clients that invest for income today are the clients that are already retired, that have done 40 years
and are
careers.
moving investments.
Yeah, and then we're like, well, you've got your portfolio with us, you've got X amount of properties, you've got X amounts of money in your pensions, ISAs, stocks and shares, etc. Now we're going to de-risk your portfolio and look at more fixed income opportunities, which can kick out and pay a dividend, or an income yield, whereas your stocks are paying dividends, yields and growth. So it really just depends. If someone wanted to achieve X in 5 or 10 years, we can put a strategy together for them. But
it's not as cost effective.
It means putting a bigger deposit down, and you get less growth, you get less ROI that way.
So really, if you're hedging your bets on both, realistically, you've got to put like a good 20 years aside to really see that. 2025 for
a decade.
What's your standard mortgage, right? Like 25?
25 years is a standard mortgage.
So let's say if you're 25 and you want to retire at 50, you've got to start making moves of starting that process really, haven't you?
And this is the other thing, Steve, as well. I mean, everyone has...
Because at 25, I had minus 15 grand in my bank account, so I was fucked.
They've got to pinch yourself and go, do you know what? Pat on the back, I'm doing well for myself. You're in your 20s or early 30s. And I always get speaking to people, and I'm like, okay, you know, what age are you going to want to retire at? And people in the 25s think, I'm going to retire at 35, I'm going to retire at 40, I'm going to retire at 45. I once thought that way, right? And now I'm 39 in April, by the way. I'm getting on a little bit. Now I'm 39, I'm like, I'm not ready to retire. I'm not in a financial position that I would retire right anyway. Now. But even like, I'm not ready to retire. I'm like, I want to work for another 10 years. I'd be bored out of my mind if I weren't working.
And the other thing is, like, with an online business, you can over that 10 years, you could set it up to a position where you actually...
You don't need to be inside.
You know, when I was doing GRT, I was working 2 days a week. That's why I started fucking doing the business mentoring, because I was fucking bored. Yeah. Because I was like, I've done my Monday meetings. What should I do?
Well, look, do you know what? You can be full time at what you're doing, and make as much money as possible. Put a property into your portfolio every year or every 18 months. That's a save point. 10 years later, you might want to come out of your business a little, do less work on your business, and be a director of that property company.
Or maybe start doing that flipping stuff and hire someone.
You're in a completely different financial position. You've got assets and save points behind you. You've got security to make those. You've got options later in life then. Whereas at the minute, you know, again, I talk about entrepreneurs. Entrepreneurs sometimes have too many different things going on at once.
Fingers in
Just
pies.
focus on what you're good at. Okay, if you're good at doing a certain thing, and this is what I've done since being 24, 25, 26, I realised that I was good at working in wealth management, and I've just run with that for 13 years as a financial advisor now. This is my best way of making money. Okay, this is what I'm good at. Don't get distracted trying to do too many things at once. Just go with what you're good at. Build up wealth over that decade. And then start putting your money to work. But when you're putting your money to work, you want it to go into investments that are passive, that are not causing you any headache or stress, and someone else is managing it for you. Yeah, you're delegating the tasks, because if you're putting time into doing the other stuff, that's time that you're not putting on into your own business. And at the minute, your business is what's working well for you. Your business is what's actually making you the most money, right? So if you could put more energy and effort into that, you're going to increase your revenue, you're going to increase your income.
And me knowing the margin in an online coaching business, like if you're doing 20k a month, you can do that with really high margins, and you can have that 50k every single year, like clockwork. And you still got enough money to spend on systemizing the parts of the business that actually make the money. So it is a safer bet as there's no such thing as a safe bet, but like you're hedging your bets really smartly at that point.
Do what works. Do what's proven. Do what you know is working for you to generate profit and income.
And is that what you look at with clients? Like generally, like a property a year will.
Yeah, I mean, look, everyone's different. Firstly, it's making sure that you've got enough money in your emergency fund. Yeah, and even just looking at like an audit of your income and outgoings and business. You need income, okay, but most importantly, you need a surplus income. Yeah, you can be income rich, you can be earning 250k a year, but if you're spending 250k a year, you're never going to be wealthy. You might be perceived to be wealthy because you look like you're wealthy, you're living the greatest lifestyle ever, but you're not actually generating wealth, you're not actually creating wealth. So it's all about having a surplus income. That's very important. And the only way you can get a big surplus income is either earn more or spend less. Yeah. So a lot of the time it's looking with clients and saying, look, you're accountable to me. You know, what you're spending your money on. Okay, where's your surplus income? Build up an emergency fund, build up a float. That's your safety net. Everything over and above your flow, everything over and above your safety net needs to be invested. So there's really two strategies that I do for my clients. It's either invest monthly into the stocks and share market, managed funds, ETFs, etc., and you can buy in monthly. So you've got consistency. Yeah, you can actually do it every single month. First of the month, before you spend, invest. Pay yourself first, pay your investments first. And just run with that for 3, 4, 5, 10, 15 years. And over time, there's going to be money there that you could even use to put as a property deposit.
Oh, that's probably really clever because it just gets it out of the fucking bank account,
out of mind,
doesn't it?
And it's not linked to a debit card, so you can't spend it. Like when there's a big balance in your bank account, right?
My brain does it. I start looking at what I can turn that into.
So it's like there's the temptation to spend it, okay? And knowing that you've got all that money in your business bank account or your personal bank account, you subconsciously you do take your foot off the pedal.
I've never done it because I've never left it in there.
So it's like move it sideways. Don't spend it on material things. I mean, at the end of the day, everyone likes a nice watch or a nice car or whatever, but don't be greedy with all that stuff. You've got to make sacrifices to get ahead in life. Move it sideways. Put it into something that has a proven history of going up in value that can also pay out a passive income. So property or stocks and shares, because stocks and shares, you've got growth, you've also got dividends yield. Property, you've got growth, you've also got rental yield, and you can leverage it. So there's a real good power there. And then basically, your bank balance has gone down. Okay, the money's been moved sideways into an asset that's going to grow. You fill the tank back up, and you rinse and repeat. So you either fill in the tank back up monthly and put in money into investments monthly, or you could just go, do you know what? Every time I've got 50, 60, 70k above my reserve value, I'm putting into a deposit for a property. And before you know it, like honestly, even getting 4 properties, 5 properties, you're comfortable. Yeah, you might not be getting income from them now, but 5 properties is enough to retire on 20 years down the line. Get to 10 properties, you might be talking millions and millions and millions of pounds of wealth when you retire, not just 1.2 million. If you get to 10 properties, depends how much they're worth, but you could easily be clearing the 5 mil mark quite easily. Wow. Yeah, and it's only from 50, yeah, depending how many you buy in.
If half a mil.
Yeah, you might put $500,000 and could easily be worth 4 mil, 5 mil.
Which you can do in 10 years as an online coach. Yeah, like without having to earn, you don't need to earn 100 grand a month. If you're just consistently knocking off like 15 to 20 grand months and putting that one property aside over the next 10 years, you're sweet then, really, aren't you?
It's definitely achievable, mate. And again, I just think back to myself and and what I've earned. I mean, I was living in the UAE, so I weren't paying tax. I was earning a reasonable amount of money, but I know what coaches earn. I know what coaches can earn. Okay, there's not a lot of differences, right? And within a decade, I got to a point where I moved back to the UK in a completely financially different situation than when I went to the UAE at age of 26. Obviously, I had the benefit of not paying taxes, but I literally invested half of everything that I earned in a 9.5-year period. I had half that I spent, and this is pretty similar to yourself, half that I spent and travelled and, went all over Asia, went to Vegas, went to Marbella, Ibiza, did all the travelling. I love to travel, and I think experiences in travel you don't want to cut back on. But half of what I earned, I invested. And that compounded over a decade. I invest into properties, I invest into stocks and shares. That's all I've ever done, and a little bit of fixed income. And I got to a point where I've got sufficient wealth now where I just know I'm that safety point. If I stop working tomorrow, I could live off what's there at a reasonable amount of income, but probably wouldn't be the quality of life that I'm used to living now, which is why I'm still working I'm still working for another 10, 15, 20 years, let's say.
Yeah, that's the way that like we've drawn it up in it. Like I have the base that like I just live off. Like that's what it costs for me to kind of go about my month, and then it's like it's actually turned into sort of 3 branches now instead of 2. So it's like one is investments, the other one is like fun, and the other one is like future business stuff. And I tend to put some aside. So if something does come up that's maybe out of your realm and it's more of a business decision, I've got at least that pot there as well.
The other thing I always say as well to clients is, most people just wing it, right? You think about business.
I mean, I did. Like before I started investing with you, I made so much money, and then when I'd actually looked at what I had, I was like,
do you?
Well, it's not even that. Like I had that lump that I was able to kind of put in and start it all off, which was decent. But like if I think about how much actual revenue I'd made compared to after all the taxes and after I'd done this and done that, how much I actually had left in a pot to invest, I was like, oh fuck, I've wasted loads of that.
It'll be the same with how you manage your clients and people that go into business. Do you put a business plan? Do you write a business plan? So when it comes to investing, have a plan, have a strategy. If you've got the capability and you've got the surplus income, then you actually need a plan and you need a strategy, and you need to go, I want to have X amount of money, wealth at that age, that's 10 years from now, and then put the plan, put the strategy together. And this is what I do with clients. I'll give them a suitability report that basically lays all that out, okay, depending which products and, which asset classes that they're going to. Because if you don't really have a plan and you don't take action, you're just kind of hoping that you're going to become wealthy at some point in the future. Yeah,
I agree. There was loads of more questions I've got, but I think that wraps it up really nicely, to be honest, with like a couple of different options. And if people are listening to this, how could they get in contact with you? What's the best way to kind of get started if they're thinking about it?
So just get in contact with me via my social media, via my Instagram. I've only just started using social media a couple of years ago for business. But yeah, Ryan_wealth coach on Instagram. Got my links there. You can make an inquiry. You can book into my diary via Calendly. And initially, it's just an informal chat, kind of see if the glove fits. I give people lots of kind of free, basic financial advice just over messages and just over that first call. And then if we feel that there is areas of common ground and you do meet my kind of client criteria, client demographic, we'll book in for a consultation call, and then we'll book in for an actual financial recommendation call, and then we'll just get going and start making the clients some profits and get the money working harder for them.
Perfect. And if you're growing your business and you don't have enough money to invest in, Ryan, then give me a message and I'll help you with that side of things. No, that was really useful, mate. Thank you.
Brilliant. Thank you.